In an intelligence-led operation in the early hours of today, India struck the biggest training camp of the Jaish-e-Mohammed in Balakot.
आओ हम सब भारत के पराक्रमी वीरों को नमन करें। देश सुरक्षित हाथों में है।
The fears are a bit overstated. Given the superiority of the Indian forces over Pakistan, I think it will be damaging and completely damaging to Pakistan.
In a pre-dawn surprise attack, the Indian Air Force crossed the line of control and bombed terror camps in Pakistan. The markets went on a volatile ride. Hello and welcome to the special edition of Markets Today, bordering on tension. I'm Latha Venkatesh, with me my colleague Prashant Nair.
Hi Latha, just 12 days after a suicide bomber killed 40 CRPF Jawans in Pulwama, the Indian Air Force has carried out what the government calls non-military preemptive strikes. We will discuss the implications of that on this show. Here are the big headlines.
A wild ride on Dalal Street as India launches the first ever airstrike across the line of control, targeting terror camps in Pakistan. Markets recover from an initial slump but still end with losses of over 0.5%.
DHFL tumbles 5% after ICRA, the rating agency, downgrades the company's commercial paper by 2 notches. The rating agency cites declining securitization pool and outsized deposit flow for the downgrade. Meanwhile, the Bank Nifty suffers in trade on fears of loans to NBFCs.
The rupee strengthens despite Indo-Pak border tensions, gets support from lower crude prices as President Trump calls on the OPEC to ease high oil prices. Well, those were the top 5 headlines from Dalal Street. Joining us today to discuss what's a tense and delicate situation are Nilesh Shah of Envision Capital. Our technical expert Mitessh Thakkar is also with us. And in a bit, we will get a global expert as well. Gentlemen, thank you very much. Mitessh, first just the technical view. We went down 100 points and recovered about 50 points from that level. What's your assessment of the day?
So Prashant, good evening. I think when the market kind of gapped down in the morning, our view was that we are in a non-directional sideways kind of a market and therefore the decline will get arrested. I didn't expect a very strong reversal in the sense that we got into positive at some point in time. But broadly, this looks like a market which will just chop around for some more time. The broad counters, if I was to talk about them, 10,750, 760 on the lower side, though the intraday low was marginally below that. And I think 10,900, 920 on the upside are the ranges. In case you break 10,750, I think a 90-80 point kind of decline back to those levels of 10,660 could happen. But I still don't have a big directional bias or signal on the chart to say that we are starting some kind of a short to medium term uptrend or a downtrend, and therefore a 250, 200 point kind of range might remain for the next few days.
Mitessh, thanks very much. So that's a brief comment on the setup and how things are at this point in time. Let's move on. We have Nilesh Shah of Envision Capital, who is now joining in on the show to take some questions. Nilesh, thanks very much. You've been following the day's events so far. What's the right way to think about what has happened in terms of this, in terms of the strikes, the reaction we've seen from Pakistan so far, some are still waiting that at some point there will be some sort of retaliation. And will the markets be on tenterhook? What's your sense?
Well, Prashant, in the first place, I think armed forces deserve a very strong salute for the response that they have given. And I think, and again, the government deserves congratulations for essentially backing the armed forces on this move. Coming back to essentially the likely scenario and its implications on the markets, it's actually after a very, very long period of time that we've really seen some kind of a bit of escalation on the geopolitical side. And I think this is probably the first airstrike that we've seen in many, many years. So clearly, I think at this stage, what really happened early this morning, I think so far the market has taken it in the right spirit, in a reasonably measured and
okay. Well, Nilesh, I think we have a problem. We will have to redial. In the meanwhile, why don't you do one thing? If you can listen in to us, let's just play out a soundbite of what Foreign Secretary Vijay Gokhale said when he clarified that this strike was not aimed at civilians. It was aimed only at the Jaish terror camps. Listen to what he had to say, as well as the Pak response, and we are coming back to Nilesh with more questions.
The government of India is firmly and resolutely committed to taking all necessary measures to fight the menace of terrorism. Hence, this non-military preemptive action was specifically targeted at the Jaish-e-Mohammed camp. The selection of the target was also conditioned by our desire to avoid civilian casualties.
Fourth, concluded that India has committed uncalled for aggression, to which Pakistan shall respond at the time and place of its choosing.
Okay, Nilesh, it doesn't look like this is the last we have heard, because what we got from the Pakistan side in terms of a response is that it reserves the right to respond to the Indian attack. Now, therefore, what is your sense that this market is capped, that it will go lower levels because of the inherent nature of the events?
Well, Latha, I think clearly from a market standpoint, if you really kind of do the pecking order, I think the market gets most impacted by, say, challenges in terms of a financial contagion, followed by a growth scare, governance issues, and then, of course, the last would be geopolitical. If the geopolitical thing is kind of a one-off event, I don't think the implications on the market are significant. We saw that in 2016 as well. But of course, if the geopolitical issues continue and linger on for some time, that could definitely put some pressure on the markets and in a way cap the upside. Unless, of course, we have a significant major event which really takes the market out of a specific range. The second thing, of course, is that the market has been consolidating in a range for an extended period of time. So it's not that the markets are at an elevated level and that therefore there is a reason for the markets to climb down. The markets have been in a way relatively subdued. So to that extent, the pressure on the markets could be a lot more limited than what we keep hearing.
Okay, fair enough. Actually, Nilesh, at this point, let me invite someone who is looking at India from afar, a voice who would be advising a lot of foreign investors. Nick Parsons, the head of research and strategy at ThomasLlyod, joins us. Nick, I suppose, first, good afternoon, and thank you very much for joining us. I suppose you heard what the Foreign Secretary, Indian Foreign Secretary, said, that this was not aimed at Pakistan civilians or infrastructure, that it was aimed only at terror camps and to actually preempt further attacks of which they had intelligence information. Given the kind of, the nature of the interpretation that India has placed on today's events, does it look like a limited war, a limited offence? And therefore, are you a buyer?
Well, good afternoon from London. Well, viewed from afar, and I say, of course, we're thousands of kilometres away here, but viewed from afar, this is seen as something which is part of a pre-electoral sort of move and a pre-electoral drive. And to the extent that this ends up offering some support for the government, some popular support, then it's not seen as being a particular negative. The other factor, of course, to bear in mind is that both the Nifty and the Sensex are only where they were on the 1st of January. The market has been something of a laggard in 2019. Let's remember that last year, 2018, India was one of the best performing equity markets in the whole world. It hasn't had that same sort of move in the first 2 months of this year. There isn't a lot of speculative short-term capital that's about to flee the country. And I think the reaction in asset markets today looks both measured and appropriate. There's certainly no signs of panic viewed from this distance, at least.
Okay. Well, Nilesh, what exactly will you do as an investor at this juncture? As you pointed out, the markets are not elevated, but they aren't terribly cheap either, given the fact that our economic growth problems continue to linger. I mean, auto sales numbers are not doing too well. Debt markets are not doing too well. So, therefore, are you looking at current levels as a good opportunity to buy at all? Especially because there is a veneer of fear, which is why the markets lost about 100 points today at its worst.
Well, Latha, the best thing to do in an environment like this is to kind of really not get too focused on the macros, or rather I'd say that kind of look out for businesses and sectors which will probably get the least impacted by the emerging macros, whether macros to do with either growth or what's really happening in terms of geopolitical kind of considerations. So clearly the pockets of strength clearly have been the consumer banks, the consumer sector, technology. These are really some of the sectors which have really grown consistently, and I think probably are the least impacted by what's really happening at the very macro level. So clearly I think as investors we probably need to be focused on these kind of pockets and try and take advantage of the market volatility to kind of keep building positions, as long as you clearly have the conviction that the medium to long-term growth is intact and valuations are kind of reasonable.
How would you react to what Nick Parsons just said, that in fact this strengthens the current government's position, on the eve of election? It's seen as perhaps better placed in a time of terror and tension. So will that be actually market positive, what happened today?
Well, that probably could be the kind of the political narrative, and clearly I think it definitely, of course, in a way, it kind of in a way creates some more popularity for the incumbent government. We saw this during Kargil in '99, and where the government in power that time got voted back, and I think if I remember correctly, the NDA ended up doing much better in '99 versus where they were in '98.
Yeah.
So I wouldn't be surprised if it's kind of in a way.
Okay, we do have a problem with this line.
Bordering on tension is what we're calling it. The market, of course, did much better than what it looked like at one point. The Nifty from the day's low was up 100 points, although from the highs it was around about 60 points. We're in conversation with Nick Parsons from London, and we've got Nilesh Shah in Mumbai. Gentlemen, thanks for staying on. Nilesh, let's move on and look at some of the issues which have dominated mind space now for last couple of months, actually. What do you make of ICRA's rating action on DHFL? And will that open up a new front in terms of worry for financial institutions and markets in general?
Well, Prashant, it's hard to kind of really at this point of time in a way accurately gauge or assess whether there would be similar problems. But I think what it looks like is that the headwinds for NBFCs and HFCs, they continue, they seem to be persisting, they continue to be unabated. So what it looks like is that they are going to kind of get into an extended period of challenges. And I wouldn't be surprised if the current round of challenges persist for maybe another quarter or two, where they deal with issues of liquidity, growth, asset quality, in some of the cases beyond liquidity, including solvency. So I'd probably still say that as an investor, one has to watch this space very carefully and still be very cautious of the NBFC and the HFC space.
Can there be an accident, Nilesh? That is the worry. If word gets around that some of the paper is subpar and investors start pulling out money from mutual funds?
Well, what it looks like is that, of course, we were pretty much close to that accident sometime in September, October. And in a way, that accident has been very successfully averted. And what it looks like is that there are a bunch of private equity funds, some very large funds, who are willing to kind of step in and bail out some of these companies. So I think as long as there is interest from the private equity players, I think it's pretty much fine.
Okay. Nick Parsons, what's the view from afar? Are the Indian debt markets the fact that there has been a little bit of money pulled out from mutual funds and that a lot of NBFC companies are facing distrust and therefore are not getting bankrolled. Is this a problem at all that worries you?
Well, I think the more attractive investment in the fixed income space for overseas investors is in government debt rather than corporate debt. Corporate debt is notoriously volatile at times of stress, and the experience of the last 6 months or so has led investors more generally to take a very defensive stance. And I think sovereign debt is clearly going to be an outperformer in times of any stress, whether that's real or perceived. Just the worries about possible future stress are enough to cause credit spreads to widen. I do think sovereign bonds are the place to be, and given the yields that are available currently on India, that's something which is still seen as very, very attractive. Because, of course, if you look at the performance of the currency, and if you look at what's currently implied in forward rates for the rupee, then investors are buying have got themselves a lot of protection through bonds and through the yields that they offer, and they still seem quite comfortable with that. So I would say it's sovereign bonds over corporate paper is still the trade to have.
Nilesh, one opinion which I think at least I've heard ad nauseum being expressed is this is a year, because of elections or whatever, you should stay away from mid-caps, small caps and pile into large caps. And, the same sectors, IT, maybe consumer. Okay, I think we've lost Nilesh's line again. Let's take this to Nick. Nick, if you've been tracking the markets here in detail, mid-caps and small caps are really, at the absolutely crushed valuations, levels. To give you an example, about 60% of all traded stocks in India are down at least 50% from their from their 52-week highs, 1-year highs. So that's the extent of the damage. Where the consensus opinion is stick to large caps, mid caps and smaller stocks are just too risky. Sometimes consensus is right, sure, but what's your opinion? If you've tracked markets in some detail, the smaller stocks, etc. as well.
Well, that would certainly be the way in which we see investors in Europe playing the Indian market. Go for the well-trusted, the well-established, the well-known names. Go for large caps over smaller caps as a more generally defensive play. And let's bear in mind, of course, that we can't look at India in isolation, because we look at movements on the day, we look at movements on the week, we look at the impact of specific news. But of course, we have to look at what's happening more broadly across the investment universe. And here we are with the US markets back to exactly where they were at the beginning of December. The Indian market, whether we look at the Sensex or the Nifty, as you well know, is back to where it was on the 1st of January. So yes, there has been a lot of sectoral rotation. There's been a lot of movements within the space of small caps, medium caps and large caps. But overall, the main indices are back to where they were 10 or 12 weeks ago. 10 or 12 weeks ago, there was an enormous amount of worry in the US about what were Fed policy, what was trade and tariff policy, and what would happen to corporate earnings. Those worries have dissipated. They've taken us back to where we were 10 or 12 weeks ago. But if we ask ourselves, what's the impetus for another leg higher from here, then it's difficult to see, quite frankly. So we've undone the near bear market conditions that we saw at the end of December. We've got back to valuations that were pertaining previous to that. That seems to be an understandable and justified move. But for the next leg higher, we need not just the absence of bad news, but we need positive good news. And frankly, it's difficult to see from where that's going to come at the moment.
Okay, well, it could come if the government came with a decent majority, but that's about 3 months away at least, if not more. A final question to you, Nick. We are not yet able to connect with Nilesh. That question is about Pakistan's economy. the fiscal deficit over there is nothing to write home about. The current account deficit is even worse, and that country was on the verge of taking more from the IMF. Given that, would foreign investors assess that it will not be in Pakistan's interest to escalate tension, and therefore you won't give this skirmish too much value?
Well, that's one possible assessment, but the truth is that Pakistan is considered a frontier market by many investors in Europe and North America, and simply doesn't feature on their investment radar other than for a very few very specialised funds. India, by contrast, is the 6th largest economy in the world by the end of this year, assuming 6% growth and relatively stable currencies. It will be the 5th largest economy in the world. India is a very different investment proposition. And I don't think that the interest that we see in India is in any way, shape or form going to be replicated in that of Pakistan. For very many investment professionals, it's simply a no-go area, and therefore the overnight news doesn't terribly change that very much.
No, Nick, just to quickly wind up, I'm out of time, but what I meant was that would you bet that there won't be an escalation and therefore continue to remove war as even a probability in the whole situation? That's what I meant. Do you think, given the situation of Pakistan, escalation is not even an option, and therefore you look at India only on economic terms?
I think that would be a fair assessment. We should never discount the reactions of a weak and wounded person. They can sometimes be very unpredictable. But overall, the sanguine reaction amongst investors, initially at least, would suggest that they are betting against an escalation of problems.
All right. Let's hope it remains that way. Thank you very much, Nick Parsons, for joining us in this special Markets Today Bordering on Tensions show. We wrap up this special edition. Thank you for watching.